Chuck Norris is back, so it's time for some real talk, but this video is going to be much more than that. I'm going to share where I think the market could be headed. We're also going to share 10 stock picks from the community. We're going to look at market news, a stock market update on CPI, earnings that's coming up. Earnings season has started. We're going to look at some different charts, some different opportunities. Plus, I asked the question in the community tab, basically asking you guys what questions you have for me. Ask me anything. I'll try to answer as many of those questions as I can. I'll do that in this video as well. So this video is going to be jam-packed with information, get you up to speed on the stock market and opportunities where you could be buying stocks. Of course, the headline, inflation just rose 0.2% in June. This was yesterday, less than expected as consumers get a break from price increases. The Consumer Price Index, CPI, which measures inflation, increased 3% from a year ago, the lowest level since March of 2021. On a monthly basis, the index rose only 0.2%. Now, the estimates were 3.1%, so it was lighter at 3%, lighter again at 0.2%. And you can see back in June of 2022, we're at 9%. Now today, only 3%. So look at that on your screen. June of 2022, 9.1%. You can see it slowly come down to 3% here just yesterday. That's 12 consecutive declines. Now, of course, this is important because the Fed is still thinking about raising interest rates. The consensus is that they're going to raise rates this month. So earnings season is kicked off this morning. Delta Airlines, it was up 4% earlier. It's come back a little bit. Reported its highest ever quarterly earnings and revenue and raised 2023 earnings forecast. Pepsi also reported stock was up 2% this morning. Pepsi beat on earnings and revenue and also raised full year outlook. So that's going to share some sentiment in two key areas: travel, which is showing strong demand, and consumer staples. So it's showing us that the consumer is still strong. Let's look at the forward PE ratios for the S&P indexes. This is going to be large cap, 19.2. So you can see it's not back to the highs of 2021, but it's come pretty far off the bottom. Next, let's look at the S&P 400 mid cap. Now, right now, we're at 14.2, and that's still pretty low historically. This goes all the way back to 1999. And you can see before the dot-com bubble, we were up here above 20. It dipped down here to about 13, and we're sitting not too far off that right now. So there's lots of room to grow in mid cap. Small cap, same story. We're down here at about 13.7. And the only time you really see it much lower than that over the last 20 plus years is in 2008 and 2009 when we got closer to 10. This is a chart of the Russell 2000. And you can see it's kind of in this wedge and it's trying to break out through that. Right now we're sitting at this R2 and this R3 up here is about 2009. If it can break this red line, get up to this R3, you could see it go much higher, maybe 2050. So this is the median forward PE ratio for the S&P 500. Right now it's at 18.1. So if we can see some breadth, we can see some of those small caps and mid caps start to participate, which they have been the last couple of days. It could take the market much higher. So those large cap tech stocks, those mega cap tech stocks, those main 7 stocks, they've really carried the market so far in 2023. Apple, that's 7% weight of the SPY. That's up 45% year to date. Microsoft is a 6% weight of SPY, up about 40%. Amazon, 3% weight, up 53%. NVIDIA, 3% weight, up 190%. Tesla's 3% weight, up 119%. Google at 2%, up 33% year to date. And Meta, Facebook, 2% of the index, up 150% or so. So next we're going to look at some data and see where the market could be headed. So we're going to look at some previous bear markets and make some comparisons. Now, of course, just because it happened in the past, it doesn't mean it has to play out the same way. But I think it's important to look at history because oftentimes patterns in history does tend to repeat itself. Before I do that, I want to share the first stock pick from the community. Now, this stock pick is from yours truly. The stock is Vertex Pharmaceuticals, ticker is VRTX. Now, the 52-week range on this is $271 to $354, so it is getting back close to those 52-week highs. But it's trading right now. This is a trailing 12-month P ratio at 27.57. It's a large cap, about an $89 billion market cap. And you can see it's kind of consolidating here, and I think it could pop higher. Now, with all these stocks, we're in earnings season. I believe these guys report early August, so that's something to keep in mind. Now, Vertex has only about 1% short interest, so it's not much at all. Price to sales ratio is 9.65, price to book 6.17. That PE for this year's estimate, though, is 23.7, and next year's estimate, 21.6. This is an article from May from one of my peers at Motley Fool, 7 reasons to buy Vertex Pharmaceutical stock now. Just a quick bullet points: recession proof, thanks to a monopoly. This is talking about CF, cystic fibrosis, and even more powerful CF therapy on the way. On track to launch its first CRISPR gene editing therapy. So they're partnering with CRISPR. Number 4, a promising non-opioid pain drug waiting in the wings. Number 5, targeting a new market that's bigger than CF. A potential cure for type 1 diabetes in development. That could be huge. And a cash stockpile of $11.5 billion. So here's where history says the latest bull market is headed next. So DataTrek Research, the firm compared the current stock market surge to 4 prior bull market cycles that began in 1990, 2002, 2009, and 2020. They found that there's 2 types of rallies. One type is a high octane rally like we saw in 2009 and 2020. S&P surged more than 60% after 185 trading days. The other type is slow and steady like we saw in 1990 and 2002. Bull markets where the S&P 500 jumped about 30% after 185 trading days from its bottom. With the S&P 500 having bottomed in mid-October or 185 trading days ago, we've rallied 24%, putting it in the slow and steady category according to DataTrek co-founder Jessica Rabe. Now you have to keep in mind too that the stocks that have been participating are really those 7 large caps, mega cap techs that we talked about earlier. And as small cap and mid cap starts to participate, it could fuel this rally higher. So I think you have to be selective in what you buy here. And for me personally, I would probably be focused on smaller and mid cap type stocks. So if this analog continues, the index may be mostly flat over the next 3 months until it anniversaries its October 2022 low. The S&P only gained 1.3% over the next 66 trading days from today when taking the average of our 1990 to 1991 and 2002 to 2003 comparisons. It's a similar story for the NASDAQ, which is up about 35% since its bear market low. This is closer to the 1990 and 2002 bull markets than compared to the 2009 and 2020 bull markets, which saw gains of more than 60% from the bottom. So I'm not saying this is going to happen, but we're up 35% year to date. And if we had a run like we did in 2009 or 2020, the NASDAQ could still go up, 25% to match that. But this is saying it's more in that slow and steady camp. So the NASDAQ follows the same pattern from the 1990 and 2002 bull markets, and it has so far. So it could see gains of about 8% over the next 3 months and gains of 18% over the next 6 months. Here's a chart kind of breaking that down. There is one catalyst that could shake the current low-paced bull market into a faster-paced, high-octane type of rally. And that, of course, is if the Federal Reserve decides to pause rate hikes. I don't think the Fed is necessarily going to cut rates this year. It's possible, and they could certainly still raise 25 basis points this month. Most people think that the Fed's probably going to raise 2 more times 25 basis points each. But the question is, do we need to do that when inflation's down at 3%? Now, the Fed target is to get to 2%. But you also have to remember that the data that we get on CPI, it's lagging data. And there are some people in the camp that inflation's going to recelerate, and that could happen too. There's also a camp that talks about how we could still have a recession. Technically, we didn't have a true recession, and that we could have one that's lagged. That could happen in 2024. So this from Fidelity is saying ignoring rates and focusing on earnings. Stock valuations have become disconnected from interest rates. So the actual S&P 500 4P ratio up here at 19.5. If you model that P ratio based on 2-year nominal treasury yields, that's the orange at 12.3. If you model that P based on 10-year real treasury yields, you have this light green color here at 13.8. Coming back to the disconnect between stocks and interest rates, another way to look at this is with financial conditions index. Rather than only looking at interest rates, these indexes take a more holistic look at an assortment of financial conditions to give a view on how monetary policy and overall financial conditions might impact GDP. So this is a Goldman Sachs Financial Conditions Index. It's back at levels first seen a year ago when the market was expecting the Fed to take rates to only about 4%. Yet today, markets are expecting the Fed to take rates as high as 5.4%. So financial conditions are looser than one might expect. And this is saying that maybe we're a little bit ahead of ourselves. The market's forward-looking, so the stock market is trying to look past this. History shows the risk if PE ratios recover too soon. In the 2000 to 2002 bear market, for example, there was a premature recovery on the valuation side just before the bottom fell out for earnings, making for an all the more painful decline. I'm not suggesting that's happening, but it's a possibility. So the next pick is from a Discord member. His name is Matt. Matt, and it's Star Surgical, ticker is STAA. PE ratio on Fidelity, again, this is a 12-month trailing, is 86.55. The 52-week range is $46 to $112, trading at $58.76 today. Earlier this year, we did the Fired Up Wealth conference series. So we did a series of 13 videos, 14 videos, and Matt came on, he joined me on a podcast, and he shared the reasons why he's bullish. You can watch all those videos, go check out patreon.com/firedupwealth. They're worth your time. This stock here is trading at about 9.13 price to sales. The price to book is 7.96, and that PE for next year's estimates at 47.2. So if you're not familiar with what Star Surgical does, they design, develop, manufacture, market, and sell implantable lenses for the eye and companion delivery systems to deliver the lenses into the eye. So let's look at the different sectors here. I think this is really telling. That orange color is information technology. Tech has been on a rampage. Consumer staples have gone down, and that makes sense. If you think it's going to be a bull market, you're going to sell the consumer staples and you're going to buy the growth and the technology stocks. Healthcare's also dipped, and there's some opportunities. In fact, a couple of stocks I'm going to talk about later from the community are healthcare related. And then consumer discretionary, you can see it's done okay, but it dipped a little bit. Really, information technology is dominating. And this next one in the red here is energy. And you can see back in 2020, 2021, it was beaten down, had a nice rally here in 2022, and it's given some of that back here in 2023. Materials has really kind of been in a slow, steady grind downward, and industrials really have been flat for a long time, and you're kind of sitting at the same levels. And this is showing communication services, financials, real estate, and utilities. So financials are looking maybe attractive here. Utilities might be attractive here. In fact, all four on your screen, they look like they could be opportunities. And those could be areas that you might want to dive into to find some individual stock picks. So next, some real talk. I'm going to answer questions from the community. Before I do that, I'm going to give you two more stock picks. So a couple different people in Discord mentioned these stocks, including Matt, Bank of America and Nike. These are stocks that they're looking to add to their portfolio. Now, keep in mind the precedent here in Discord, we were buying heavily in 2022 and the beginning of 2023, and we teach blueprint methodology. So these members have already bought a lot of those growth stocks, and now they're focusing on where they think there's value in the market. And they might not be the exciting hyper growth type stocks because they already own those and they have full positions in their portfolio. Now, with earnings season coming up, there's probably going to be some opportunities of some of those favorite names, so have some cash ready. So here it is, the community tab on YouTube. I'm recording a real talk video later today. If you have a question, ask below. I'll select a handful and answer them on this video and give you a shout out. Let's do it. So these answers I provide, straight real talk, nothing's prepped, nothing's rehearsed. I'm going to read these questions for the first time and just give you my honest answer. So Kyle M8117 would love to hear an update about Broadcom, Marvell Technology, and Lam Research buy points and if they're future growth stories. They've run a lot and I don't want to chase. Well, this is going to be the hard part with a lot of these quality companies, especially these growth names. And I know you don't love hearing me say this, but I've been long on these stocks and I was sharing buy points, early this year in 2022 of where to buy them. I remember specifically doing a video about Broadcom saying this is a buy at these levels. Marvell Technology was on one of those top stocks to buy, best stocks to buy. Stock's up 75% or something since we talked about it. Lam Research, I remember in Discord pounding the table when it got to the lows in 2022. And I've been long in all three of these. The longest I've owned is Lam, and then it's going to be Broadcom, and then Marvell Technology. Probably 2021 was the first time I bought that one. All three of these are high quality semiconductor names. I don't have a chart in front of me or anything. I'm just going to tell you that, it's going to be tough. You have to really build a watch list of your favorite companies, and maybe there's an earnings miss. Maybe there's a market sell-off and you take advantage. Now, if you're a long-term investor, it might be one of those things. If you don't have a huge portfolio, every paycheck, you're just buying more. And we'll talk more about that later in the video. Hopefully somebody asked me that question. If not, I'll try to remember to go back to it. So I guess the short answer here is if you're bullish on these companies, if you really think that they're going to be great investments in 5 or 10 years, there might not be a bad time necessarily to buy it, but obviously you want to buy the lowest prices you can. And this makes it really hard as an investor. And that's why it's so important to really be constantly buying, especially in a bear market like 2022. So the next question from Elliot, what sectors, certain stocks in particular, are you most interested in keeping an eye on going into the second half of 2023? Keep up the outstanding work, Eric. Very much appreciated. I appreciate the comment. So on that conference series, those videos, I'm telling you, this is worth the investment, guys. Go to patreon.com/firedupwealth. And these videos were made in Q1 of 2023. And we went into all the different sectors. So we looked at secular growth trends, all the areas that we think are going to be mega trends over the next 5 and 10 years. And we build a blueprint off that information, try to find the best stocks, the best in breed for those different growth segments, for those secular growth trends, those mega trends. So the question, what sectors are certain stocks in particular? This is stuff that I share in Discord. I share not only my watch list of what I'm looking at, I also share what I'm buying, what I'm selling, and I do that in real time. So if something like this is important to you, you definitely want to be in our Discord community. Again, patreon.com/firedupwealth. There's no way to provide this information like this real time on YouTube every time we make a buy or sell. It's just impossible. So Discord allows us to share that information in a granular fashion, and it's definitely worth your investment to join our community. But I'm looking at, like Monster Energy is one that I wouldn't mind buying. I'd like to come back a little bit. If I look at my portfolio, it's mostly baked out. Most of what I have, I put as much cash as I could in 2022. I went as hard as I possibly could. I don't have a ton of cash left. So I'm buying opportunities, and I bought a few stocks in Discord today, both in my main portfolio as well as the community portfolio. And you can go sign up right now and go see what those are. I can't even talk about it on YouTube for 2 days, but I'm still looking at those mega trends if I'm looking for growth, and I'm looking for opportunities in select names. And a lot of times I buy against the grain. So when it's out of fashion, like, growth and tech stocks were out of fashion in 2022, that's when I'm buying heavy. And you'll notice that the community, some of the stock picks are going to be more of those dividend DGIF type stocks. Oftentimes, our group, we're buying against the grain. So healthcare stocks might not be popular by the overall market, but they might be a value to a long-term investor that might want to pick up something like United Healthcare. So while we're on the topic of healthcare, I'll share 2 more stock picks with you. United Healthcare, which a lot of members of the community have been buying this. We have an investing trade floor, and it's filled with UNH buys. I'm looking at it right now, United Healthcare. So 15 shares at $449.97, 4 shares at $450, 2 shares at $450.99. There's just a ton of these. There's another one, United Healthcare, $449.92, $452.98, United Healthcare. There's a lot of United Healthcare buys on here. The next one that's healthcare related is going to be BMY, Bristol Myers Squibb. And this is from Tyler in the Discord community. He did a great job, little write-up for each of his picks. He goes by Tyler Sooner Fan. And every time I see it, Tyler, it always looks like Stoner Fan, but it's Sooner Fan. He's from Oklahoma. BMY. I like Bristol Myers Squibb at the current price. 15 straight years of dividend increases, trading at a discount based on currently based historical PE ratio. With the huge $90 billion Celgene acquisition, cancer drugs he's talking about here, back in the 2020s, their pipeline's filled with a lot of great current drugs as well as opportunities for the future. Management expects current and new products coming to the market to bring $25 billion or more by the year 2030. He says his wife is a heart failure NP. I asked her about a few of the heart-related drugs. A cardiologist friend of hers said that one of the drugs is a BMY drug, and he goes into more detail about it. Oh boy. DJ Husky, if you were to build a recession-proof portfolio, which 10 stocks ETFs would you have? This is great. Well, here's the thing. I don't try timing the market. So I'm not going to change my portfolio and sell everything and go buy a bunch of consumer staple stocks and try to time the market and guess what's going to happen. That's just not what I do. I buy stocks and I'm holding them for 5-10 years. And even if there is a recession, I'm just looking at that as an opportunity. I'm looking at it as an opportunity to buy more, just like in 2022. So if I were to build a recession portfolio, the reality is I just wouldn't. But if that's something that you want to do, you would look at consumer staples, utilities, stocks like the higher dividend yield type companies with strong balance sheets. Those are going to hold up a little bit better. People are going to flood to safety. So they're going to sell those growth stocks and they're going to go into a lot of those dividend stocks. And you saw that exactly happen in 2022. AbbVie was on fire last year and now nobody wants to buy it. And that's exactly why. There's other reasons too. There's healthcare issues and so on. But just in general, you see a lot of those dividend stocks that perform very well in 2022 that are underperforming in 2023. People are selling those stocks, they're taking that cash and they're buying these growth stocks. If you're long-term investing, this is from Aaron Taylor 2167. If you're long-term investing, is there ever really a bad time to buy? Here we go. Good question. For example, I want a certain amount of Tesla shares, but it, like many others, has run hard. If I plan on holding for 5 to 10 years, does it really matter if I buy now versus it letting it cool off a bit if it ever does? This is a great question. It's a hard question to answer, and it really comes down to the individual. And I'm going to read something here that I posted on Twitter. So this is a response to Dylan. Shout out to Dylan. He does a great job on Twitter. Dylan's 32 years old, and I replied back. So he's basically saying, he's kind of waiting for a correction to happen. Here are the stocks that he wants to buy. And I say, hey, at 32, buy the best prices you can every single paycheck. The luxury you have right now, number one, is you have a job, you're getting paid every 2 weeks, and you have a lot of time on your side. So this is my 2 cents. You have so much time. Pick the right stocks. So your due diligence is going to be critical because you have to buy the right stocks to hold for 5 and 10 years, and keep buying. If you have 20 years, you have the most precious asset possible, time in the market. I'm all for using technicals to get the best prices and so on. We do chart day every single Wednesday, and I tell you what levels I think a stock's going to go. And I'm all for buying the best prices. I'm in a different situation though. I'm more in capital preservation at this point than accumulation. Now I still buy growth stocks, but only when I think they're an opportunity. But I wouldn't get too fixated on timing exact bottoms unless you are investing huge chunks at a time. If you're in accumulation phase, it's very different than the preservation phase. Periodic DCA works. And another shout out here to 307 Fool, Matt. He's the king of this. He buys every single Thursday, no matter what. And I'm not saying just go buy any stock at any price. I'm saying buy the stocks you feel that are attractive that fit your blueprint, and always have some cash for earnings. Just avoid trying to time the market is all I'm saying. And if you're reading this, you're a trader, well, please disregard because it doesn't apply. And if you think about it, if you followed this approach in 2022, you'd be very happy right now. So many kept waiting for lower prices and missed the entire run completely. That happens every time, of course. It's why timing the market is very difficult, and it's really impossible. So here's the deal. If you're really bullish on Tesla, you were probably buying it pretty heavy when it was lower. And if you didn't do that, you have to ask yourself the question, are you going to periodically buy some Tesla shares or, a fractional share every paycheck and just keep doing it consistently? Or are you going to try to just, buy it all at once? And I don't recommend doing that. Try to DCA. There's two approaches. There's periodic DCA. You buy it all the time, periodically. Oftentimes I do that with ETFs. Or in an individual stock, the fired up wealth methodology is we might buy different lots. Now in a bear market, I was telling you guys 10 to 20 different lots sometimes because you're trying to buy stocks that keep going lower. And people say, well, that's catching a falling knife. Well, now if you look at them, well, they're all green. I mean, for the most part, there might be one or two that aren't, but everything's pretty much green. It's outperformed significantly. But it's very hard to do, psychologically, because you're buying and it goes a little bit lower, and you buy a little bit more and it goes a little bit lower. And people just wait and like, I'd rather buy it on the upturn. Well, by the time you realize it's upturn, the stock's already up 100% on some of these stocks. Now, in this case, if we're more in a bullish market, you might not want to do 10 or 20 lots. You might only do 2, 3, 4, 5 lots, depending on, just your comfort level. And with Tesla, here's the thing, like a lot of these stocks, it has popped really hard. You can have an earnings miss and you could get an opportunity. So you have to ask the question to yourself, do I want to basically try to time it and wait and hope for the opportunity? Or do I want to just buy some now and buy some more if it goes lower? And a lot of that's going to come down to the conviction you have. You have to study these stocks and understand it. So here's the thing. If you buy Tesla at $250 or at $300 a share, and it's trading right now at $275.35. So I'm not saying I would go all in on Tesla today or anything. It's trading at a 12-month trailing P ratio of 81. But if you are right with the stock, and if it's say a $1,500 stock, I think Ron Barron says $1,500 by 2030. Kathy Wood says it's going to be a $2,000 stock, in 2025 or 2027. But let's just say it's a $1,500 stock in 2030 and you buy it at $300. Well, that's a 500% return. Now, some traders, I had a comment the other day, why would I want to buy NVIDIA if it's going to take me 10 years to get a possible 10X? These traders are trying to basically get a 10X in one day. And we still have a lot of those meme stock traders, that TikTok vibe. I'm perfectly happy with a 500% return in 7 years. I don't know about you, and it's going to be up to you. And Tesla could easily not give you a 500% return, or it could give you 3 times that much. You don't really know for sure. But what you know is that there's a total addressable market. It's a high quality company. There's a strong chance that the stock's gonna be worth more in 5 or 10 years. And you have to decide what level, what premium you want to pay for that stock. So is there a bad time to buy? I mean, if you're buying the right stocks and you have the right mindset, it really comes back to psychology. If you've got that time in the market, you've got the right mindset. I mean, you always want to buy the best prices possible, but if you're buying the right stocks and you're buying them all the time, you're going to make money in the market. I've got a lot of questions here and I appreciate it. So I'm going to have to skip through some of these. I'm going to go to the next one. Which sectors do you see performing best in a potential economic turndown or downturn? This is Brennan. And I mean, like I said earlier, those consumer staples, those dividend type stocks, those are going to perform a little bit better if you've got a turn down in the market. So MMFF2, could you please do a deep dive on shoe and apparel companies like Nike, Lululemon? There's actually videos on these stocks on the channel, not on holdings, but on Nike and Lululemon. Definitely check those out. I like Nike. I think Lululemon could do well. I think all three of those could do well. I think Nike's just one where for me, it's kind of a no-brainer for me to hold it. I bought it though in 2012, so I've got a great cost basis on it, and I'm just letting the dividends reinvest. So I recognize this person, Matthew from Discord. What's going on, buddy? How often do you follow up on investments to decide if you're still bullish or losing conviction? Any advice, things to watch out for? Well, you're going to look at the macro environment, just the overall trend long term. So not necessarily macro like, oh no, the stock might sell off tomorrow kind of thing, but more like what's the direction of the overall industry, the total addressable market of the overall industry, things like that. You're going to be listening to earnings calls all the time. This is what we do in Discord. We share information about companies that we're either invested in or interested in investing in, share due diligence, and we share constant news to try to keep a handle on our investments. So how often do I follow up on investments? I mean, I'm following up all the time. Now, not everybody can do that, but that's where a community like Patreon Discord adds a lot of value because it's a service that saves you time. So you don't have to go out and, try to comb the entire internet trying to find all this different information. We're bringing it to you in Discord. But I'm listening to pretty much every single earnings report or reading the transcript or both on everything that I own. And so this is going to come back to like, how many stocks should I own? Well, I mean, you have to keep a handle on it. It's not like you just have to just constantly watch the market and listen to noise. That's not what I'm saying. But you have to keep a handle on the overall industry, the industry trends, the leadership, how the company's doing in terms of, the profitability and growth, the total addressable market, things like that. So Ben Schneider, 5443, with earnings being reported, is it best to wait until after earnings or buy before? This comes back to our earlier conversation. If you've got limited cash, you probably kind of wait. You make a list of maybe a watch list of 20 stocks. You watch those different earnings and you try to find opportunities if they sell off on those earnings reports. If you've got 20 years and you've got a small portfolio and you're trying to invest every single paycheck, well, maybe you buy some now and you buy some later. It just depends on the situation. Every investor is going to be different. So here's a rabbit hole. When investing in a company, what are the main things to look at when you're basically researching the company? I think is what he's asking here. And this is from Eon Thematic 9542. This is a great question. This is something that I can't answer in a couple minutes. And this is something that the masterclass videos do. I've got 13 masterclass videos. It's 12, 13 hours of content. And there's 5 more videos coming in 2023, starting in August. So every month, starting in August to the end of this year, we're going to have a new video for 5 new videos. There'll be 18 total masterclass videos. So you can go to patreon.com/firedupwealth and join the masterclass tier and watch those videos right now. And it's going to teach you how to research a company to see if it's something that you want to invest in. But some of these questions are starting to kind of tie together. The first thing you're going to want to understand is really the macro, the secular growth trends of where the economy, what the world's going to look like in 5 or 10 years. And that's something that you can't tangibly measure by looking at financials. Now, financials are going to be part of that equation, but you're going to have 2 different types of analysis. And one's really going to be about that tangible financial type data. The other is going to be more about the story, more of that speculative side. But you're looking at things like future growth potential, the total addressable market. Are they industry leaders? Are they best in breed for what they do? You look at the leadership. You look at the financials and lots of different metrics, growth metrics, valuation. The overall story, again, the vision of what that company could be is important as well. Now, if you're a value investor, you're not looking at the story of what it could be. You're probably just looking at tangible information like PE ratios, and you're doing free cash flow analysis and you're buying off that. The problem is that the large majority of those metrics are lagging indicators and they don't really tell you what's going to happen in the future. And as you know, in investing, past performance doesn't guarantee future results. So some of the best investors in the world are people that have that vision, that can see what it's going to look like in the future. And some of the worst investors that I know are people that are very black and white, like accountants and things like that are very logical in their thinking and they can't try to think outside of that box. Now, of course, there's going to be more speculation and more risk when you start to get outside of those tangible financials and things like that. You're also going to look at the moat, the competition, the valuation compared to its primary competition. And the overall industry matters too. So if you're evaluating a SaaS company, it's going to be a completely different thing than if it's an industrials company. And that's, again, what the masterclass tries to teach you. It tries to break different stocks down into different buckets and classifications to help you get started. And then the last piece of the puzzle, we look at technical analysis to try to get better entry and exit points. But 99% is fundamentals. That last 1% is going to be the technicals, really just, again, trying to get a better entry or exit point. So fundamentals are really important, that due diligence and having conviction, understanding what you own and where it could be in the future. Because if you don't have that conviction, when the stock sells off, you're going to panic, you're going to panic and you're going to sell. And it comes back to psychology. Investing is so much about psychology. The next one, what do you think about Nikola's stock? I don't really follow it. I don't think much of it. I'm personally not a fan of it, and it's one of those that could go bankrupt. And that's just the truth. And then what do I think about Fubo? It's another one, probably a spec type investment. I know that it's popped really hard recently here. Probably goes a lot higher, especially if the market keeps rallying and a lot of these small caps start to participate. But it is a tough sector. I don't own the stock. I don't know the company very well, so I can't give you much more information about Fubo than that. So next, I'm going to cover 5 more stock picks from the Discord community. Before I do that, if you're new here, please subscribe to the channel and click that bell for notifications. I'm trying to get this channel over 50,000 subscribers in 2023, and you can help me out by subscribing today. If this video is helpful, drop me a like and drop me a comment. I also need to announce that this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. A reminder, Fool doesn't tell me what to tell you guys, what content to create, what stocks to cover. They're a great partner. Check those guys out. And again, join us in our private community, Patreon Discord. It is worth your investment. It's month to month. If it's not for you, you can cancel anytime. There's no strings attached. Visit patreon.com/firedupwealth. So the 6th stock pick, this is from a member in Discord named Zach. Shout out to Zach. He chose Disney, and I think the news yesterday is pretty big news. He and a few others, Matt and Elia, a couple of different people mentioned United Healthcare. We talked about that one earlier. Then we've got AbbVie, Penn, and Perry. I appreciate you guys watching. Make sure you subscribe to the channel, drop a like and a comment. Have a great rest of your day. Take care.